So welcome back to another episode of Multifamily AP 360. And today's our guest is Jake Clopton from Clopton Capital. Welcome, Jake.
Thanks for having me on. Appreciate it.
Yeah, thank you very much, Jake. Yeah, tell me a little bit more about yourself.
Yeah, absolutely. So I run Clopton Capital. It's a 15-year-old commercial real estate services firm. I originally started the company and we really just did capital markets. But since then, we've grown into, again, more of a services firm. So we're also a nationwide commercial property insurance company. We do commercial solar installation. We're a 1031 qualified intermediary, and we're bringing on board a real estate brokerage side. All of these are nationwide. So, we're really trying to be involved in like the full life cycle of commercial real estate investment.
Awesome. Thank you for the introduction. How did you get into this space?
Cold calling. So I used to trade interbank hedging product futures, like 3-month LIBOR and Fed funds, all that stuff back in at the time it was a credit crisis, right? So had the idea to start an intermediary, finding money for people that were looking for credit, and really just started off by cold calling and looking for anybody that had credit to lend. It wasn't really specifically focused just in commercial real estate at the time, but it very quickly turned into real estate finance, and I've been doing that ever since. So I really don't have like a commercial before this company, like a real estate background. It was more of like a, inner works of banking type of background.
Thank you for that. So you are a serial entrepreneur, author, and economist. So from economics point of view, what factors are influencing, current market conditions like high interest rates or, inflation, all this stuff?
Yeah, well, interest rates and inflation are really the two biggest ones out there, right? But for real estate, it really comes down to, a segmented type of economy. Some types of real estate, have really strong demographic trends like housing, for instance. The rents just keep going up. Housing prices are still high because of constrained housing supply, and population growth in certain areas is just keeping that asset class really strong. That's one example. But then if you turn over to office, right, you can see different, demographic trends, people staying at home and, stuff like that, that are really negatively affecting those asset classes. So I think, when you're looking at real estate today, it's hard to just say this is what's going to happen to commercial real estate. You've got to really segment it into asset classes and then, geographies as well. And some areas are doing extremely well and some areas are not because of, again, like population flows and local economies.
Got it. Yeah, thank you. What's your take on, mortgage side? So there are a lot of, challenges in terms of, cap rates or, bridge loans, all this stuff, right? So, and also it's impacting, current lending criteria, right? So low LTVs, and high interest rates, all this stuff. So what's your take on that?
Specifically, like the ability of lenders to lend, as I
Yes.
guess.
Yes.
Well, okay. I think it comes down to a little bit of a more segmented answer again.
Yeah.
When you're talking about, the largest lenders out there are banks or credit unions, so like depositories. There is definitely some challenges in that type of lending. Banks have a lot of commercial real estate loans on their books, and they're starting to get more liquidity constrained. So when we go to banks today, a lot of times, banks are asking for compensating deposits, or they've really pulled back on lending altogether. It just takes a lot more legwork to find the right deals. Whereas before rates started going up and, bank balance sheets were healthier, you maybe had to go to like 3 or 4 banks and you could find a decent loan. Now, when we take a deal out, we're going to like 50 banks minimum, right, to really find the right loan. So our value as, a facilitator of financing, I believe has gone up tremendously, right? Because we do the legwork of finding those types of institutions. When we're talking about, let's say private lenders, there's absolutely liquidity in the private lending space. But you made a comment about like higher rates and lower LTVs. It's just a math problem, right? It's not that I think lenders are out there saying we're just doing lower LTVs, but it's more about where's the property actually work, on a debt service, and where, if, for instance, when you go to private lenders, the whole, question is how do they get out of the loan that they're putting on the property and where can you refinance it? And when you do the math, and look at the exit, a lot of times that's just a lot lower LTVs based on where current rates are and where the property currently operates on the NOI. So that's really what's constraining LTVs today is debt service. Whereas before rates were so low, we really run into LTV constraints, quite often before we head to debt service constraints. Now it's the other way around. So that's what I really think is, the big constraints in the market today. It's like, where's the exit based on where current rates are versus like debt serviceability.
Okay, got it. What other factors you would consider, when, when helping with, buyers, in this current market situation?
What other factors?
Lending is tight and,
Mhm.
refinancing, like a lot of buyers looking for, refinancing options or loan modifications, all this stuff, right? Yeah. So how exactly you're helping those kind of buyers?
The way that we help people the most is by broadening the lending options that are out there, right? So again, going back to what I said before is like, let's say you're on the acquisition side, XYZ real estate company, or for your own portfolio, right? And you identify a property, you're not necessarily a capital markets guy, right? So you're an operator and or an acquisitions guy, and that's what you're good at, right? Like finding and operating investment opportunities. You know, you may go out to a couple of banks, right? And try to find this deal, or maybe a couple private lenders. Knowing who all the people are and how to access everybody is really difficult when you're only doing it once every couple of years, or maybe once a year or something like that, right? Since we've been doing nothing but this for 15 years and we've got a great process and we know how to quickly access, a much wider array of lenders, what we can do is quickly provide much broader market access. And so if you think about it, in a way, it just comes down to a numbers game, right? To a degree. Whereas somebody, when they're looking for financing, may go out to 4 or 5 people, and that's really the time constraint of all the lenders that they're able to deal with. We can, in a shorter amount of time, access 50 to 100, right? In addition to that, what we do is, we help and provide like certainty of close, knowing like which lenders, really have the capital to lend. And it's especially important when it comes to the private lending side, knowing where their money comes from and what their credit process is. Because a lot of those lenders aren't even, really balance sheet lenders. A lot of times they have lines or they have to go syndicate stuff. And, that adds like an extra complexity of the approval process. So, I think there's a couple different ways that we bring value to the table. One is with broader access, and then two is with, better execution and understanding the credit process of lenders.
Share me a little bit more about your, your portfolio size and what kind of transactions you guys are doing, like per month basis or per quarter or per yearly basis, what markets you're targeting, what asset classes you guys are targeting.
Yeah, so we don't necessarily target one particular asset class. I would tell you what the type of finance we end up doing and the type of asset classes we end up doing the most of really has a lot to do with kind of what's going on in the cycle and where people are finding value. For instance, right now we're doing lots of construction. People are finding a lot of value building new product, and those are the deals that are working. Because a lot of time, as we sit in the market, people are still finding the math on acquisitions because rates are so high to work out. And also a lot of people are trying not to refinance right now if they don't have to, because again, cost of capital is high. So at the time for, right now we're doing lots of construction lending, also seeing, a lot of alternative asset classes, not just a lot of your core stuff, more like special use stuff, like self-storage, car washes, seeing a lot of hotel deals, stuff like that, stuff that typically I think have a little bit more meat on the bone, or just has like strong trends that are kind of making giving a lot of value to those types of asset classes. We consistently see multifamily and core product just as we're going through the cycle, but this most of is whatever is probably like the biggest trend in the market. You know what I mean?
Yeah, got it. So what size of deals mainly you guys are looking? So mainly you guys are looking for cash flowing asset classes like, DSCR, some kind of criteria, right? Greater than 1.3 or something like that.
Well, so we do fixed rate mortgages, bridge loans, and construction. So the deals that we do don't necessarily have to have a certain DSCR. For instance, when we're doing like value add bridge for shorter term transitional lending, like, obviously construction or value add bridge, as long as we can say, hey, we're taking the property from here to here, and based on, all these data points of the market, here's, it's going to work out and we're going to be able to exit, we can make that work.
Got it. Thank you. So you guys also providing other services like insurance products or 1031 stuff, how
Yep.
exactly that works, what kind of buyers you're targeting? Who will be your ideal
Uh,
customers? Yeah.
it's the same people. So those sides came about because of all the real estate relationships and the network that we built up on the capital market side, right? It's all the same people. So the target is really the same people. So for instance, the way that we work, sorry, on these different sides, they're kind of built as almost different companies inside the umbrella, right? And like, for instance, like I don't handle personally the insurance side. There's other people here that do, but quite often, and this is just an example of insurance, the finance insurance side work very much so hand in hand. Because every time we do a loan, we need to do insurance. Every time we do an acquisition, we do insurance, right? And because we are so close and we have both of these parts in-house, very often we've actually, made financing work because we can find a better policy. For instance, we had one large industrial building that we were doing. I think the policy, it was huge. It was like a 1 million square foot facility. I think the policy on that was going to be like $700,000 or something with the incumbent, insurance agent. And we were able to step in and find some of those closer to like 280, and that significantly affected the debt serviceability of the property. So you can see how like both of these sides kind of work very much so hand in hand and help each other.
Thank you. So going back to, previous one. So how are the number of applications or number of refinancing, in 2024 compared to 2023 and 2022?
Compared to today?
Oh, yeah. Overall, like number of applications or number of transactions from, lending point of view. Yeah.
Yeah, I would say compared to 2022,
Yeah.
we saw lots of refinances. At the moment, people are trying not to refinance if they don't have to. So refinance applications definitely down. In 2022, we're still seeing lots of cash out. And quite often, when somebody's, looking to do cash out or some refinance, because of that or something like that. I mean, it's because they're finding other investment properties that they want to take advantage of. So not as much of that going on because people are having difficulty finding deals that work in the marketplace. Acquisitions are not as high as they used to be, but construction again has gone really through the roof. So that's where we're seeing the most volume at the moment.
Got it. So from construction point of view, are you guys targeting any specific markets? Where do you see a lot of construction going on?
It's where you would expect, where there's lots of large population growth and like the local economies are doing well. So lots of Southeast economies are doing well and the population is increasing.
Got it. So what's your take on interest rates? So how long it will be stay same and when exactly it will come down? Any take on that?
So the tough thing about predicting interest rates is, and this comes from some of these trade interest rates for a living, right? You can get a great idea for where interest rates are going to go like today, but something might come out a week from now that completely changes the perception of where they're going to go. Like, for instance, earlier this year, everybody was pretty sure the Fed was going to, drop rates, maybe 3 times this year. Now the data has come out to suggest otherwise. And that happened in a short amount of time. I think, as we sit right now, there's really, and I've been paying a lot of attention to, Fed speak. There doesn't really seem to be a lot of pressure to lower rates anytime soon. They're waiting for more data and they're waiting for consistent data to show that inflation, has gotten under control and coming down. I think the risk out there, for rates and inflation is really like, again, one of these like black swan things, like a geopolitical risk. There's a lot of wars going on that are affecting, supply. Like, for instance, when, Russia invaded Ukraine, you saw a lot of supply constraint and that, negatively affected, inflation. So that is probably one of your bigger risks out there, which I don't think a lot of people think about, like geopolitical stuff in the world, but that does, cause a lot of price increase, especially with international trade. So I think that's one of your bigger risk factors out there that could potentially keep rates higher for longer. I don't, the economy's been incredibly strong. So I'm not sure, right, if we're really going to see some big downturn like a lot of people are expecting, even in commercial real estate, right? I mean, it's segmented, like the office sector. Yeah, sure, lots of pain, but multifamily, not so much. So I think, for the rest of 2024, I would be surprised if we saw any kind of decrease in lower ceiling than short-term rates will, because you're starting to see other economies start to lower rates and or get ready to lower rates. And those lower international rates can kind of anchor where our treasury rates are. So I think the yield curve probably stays inverted because of those international pressures of like lower rates in other economies, and that you know probably happens before we actually see lower rates domestically.
Got it. Thank you very much. So any prediction next 12 to 24 months,
Yeah, I think my prediction here is we see a lot more of the same what's happening right now, right? The sectors that are performing well, specifically housing, and the other things that go along with that, are going to do well. I think rates stay elevated for longer than people are expecting, but you see some decreases in long-term interest rates because of those international pressures. As far as like specific real estate sectors, yeah, I mean, I think you're going to see some people start to migrate towards other asset types for yield, right? There's going to be hunt for like safety and hunt for yield based on where the cost of capital is, and probably pushes people into what I'm seeing now, like into more special use asset classes.
got it.
um, as far as on the equity side, I think we're just gonna see equity start to come back into the market on an institutional level because it has to be put to work at some point. There's still a lot of money in the sidelines, and it's collecting. You can throw money in a money market account and get somewhere around 5% today. So I think they're comfortable sitting around there, but eventually people are going to be looking for higher yield than 5%, and they're going to get more comfortable with the risks in the market. We're going to see that type of money start to creep back in, and more activity, in the marketplace on the acquisition side.
Awesome. Got it. Thank you. Thank you very much.
Absolutely.
Yeah. So any personal habits that are helping you to be successful?
Yeah, I think the number one personal habit that helped kind of build this business was just consistent outreach and networking. Commercial real estate is a relationship business, and it's really hard to do that if you're not out there making phone calls and meeting new people. So I think that's the number one thing in our industry. On every side, whether you're looking for investors or trying to find capital or trying to find borrowers or whatever it is, right? That gets you ahead in this business.
Awesome. So any books that impacted you?
On the commercial, I'll tell you the first real estate book I read that kind of got me into like wanting to invest in real estate was the Rich Dad Poor Dad books. That was back when I was in college, but I'd say that was probably the first one that got me into real estate investing and looking at it. But yeah, those guys.
Outside of real estate? Outside of real estate, any other
Oh,
book?
outside of real estate, I have a book at the top of my head. Honestly, if it's not an email at this point, I'm not really finding a lot of time for books outside of real estate. So.
Sure. So how can listeners can connect with you, Jake?
Incredibly easy. Find me on LinkedIn. Hit me up on our website. Incredibly easy to get a hold of. Call us directly. I'm available anytime.
Awesome. Thank you very much, Jake.
Absolutely. Thank you.